Good evening, everyone. Welcome to our UVA Alumni Homebuyer Workshop. My name is Jason Maida. It's great to be with all of you this evening. Thanks so much for taking time out of your busy schedules to be a part of tonight's class. We're excited to bring this content to you. This is something we provide to the community 4 times a year. So once a quarter, we teach classes just like this to provide you really tools and resources to support you on this journey towards homeownership. Tonight's class is a very interactive class. So as we move through tonight's session, we encourage you to ask questions of us. You can use the chat feature within Zoom or the Q&A feature, and I'll be answering questions live on air. My associate, Ken Fleck, is also a part of the session as well. He'll be kind of monitoring the chat window as well, too. And so we'll be able to kind of answer those questions as we roll through tonight's session. We do appreciate the time that you've given us this evening. We're going to take you up to about the top of the hour for tonight's discussion. And again, we will weave in those questions as we roll through our content. My name is Jason Maida, so I will be your presenter this evening. I work for an organization called American Pacific Mortgage. We're one of the top 10 lenders in the country. Our team specifically focuses in on first-time homebuyer education. So what we do is we educate our local communities in homeownership by providing some tips and tools and resources to help you on this journey. So we hope that you'll learn a few things tonight that can help you explore what homeownership can look like. And then after tonight's class, love to be able to connect with you so we can talk through really what a home buying scenario might look like for you, or really like a home buying plan. Here's our talking points for this evening. So we're going to talk a little bit about the housing market, kind of what's happening with the current markets, but also we'll talk a little bit about interest rates and what we're seeing in the interest rate market. And kind of really some projections on what we're seeing, where our interest rates could go. We also want to talk a little bit about, does buying make sense for me? This is obviously going to be probably one of the largest purchases or financial decisions you decide to make. So we want to kind of talk through, like, what's the comparison look like between continuing to rent today versus what it could look like from a homeownership perspective. We also want to spend some time looking at credit, give you some tips and tricks around credit, how to identify areas of opportunity or credit, talk about loan programs that are available to you, many of which some of these loan programs you've probably already seen or maybe have come up in some of your searches for homeownership. And then from there, we want to talk a little bit about savings for homeownership. You know, that could be some of the biggest challenges just trying to reach homeownership, is just having enough saved that I can help meet my homeownership goals. But there's also first-time homebuyer programs that can also aid us in getting to that goal of homeownership. So we'll spend some time tonight talking about some of the Virginia-specific programs, and then we'll kind of cast a little bit of a broader net and look at some of the nationally based first-time buyer programs. And before we wrap up tonight's session, I also want to walk you through the 6 steps of home buying. So what does it look like after I leave a class like this? What should I be doing in preparing for homeownership? So I'm going to walk you through our 6 steps of home buying, and then what the steps would be to get connected with us for a consultation. You know, beyond teaching classes like this across the country, I spend most of my day working with clients one-on-one that have attended our classes and really helping them build their plan around homeownership. So I hope I have the opportunity to do that with you as well. Well, let's kind of launch into tonight's class and let's talk about, does really buying make sense for me? And again, you've heard me talk about it a few times so far. This is probably going to be one of the biggest financial decisions you make. And so when we look a little closer at homeownership, well, what does it mean to me? Well, this has an opportunity to create stability in your housing payments. So you don't have to worry about a landlord that's increasing, your rental costs on an annual basis when you re-up your lease. Let's face it, today's market, home prices are a little bit higher. Affordability is challenged in certain markets. Rates are at elevated levels. But for those of our buyers that are financially fit and ready to enter in today's market, there's an opportunity to refinance their home at some point down the road when it makes sense. So I might buy at a 6.5% rate today, but I might have the opportunity to refinance when rates go to 5.5 or lower and improving my cash flow. So stability is a big part of home ownership. Then there's the asset growth side of home ownership. I'm going to buy my home at a certain price point. That home hopefully will go up in value over time. I will pay down my balance over time as well, too. Those two numbers, market value and balance, creates home equity. And for many of us that are homeowners today, that's probably one of our largest assets that we have, probably next to our retirement accounts. So this is the opportunity to really create generational wealth for families. And then the other thing that a lot of people don't think about when they look at their budget for home ownership or thinking about jumping in the market is, what are some of the tax benefits to owning a home? Potential tax deductibility of interest, potential tax benefits when you decide to do energy efficient upgrades to your home. So when I think about home ownership, it's not necessarily like an apples to apples comparison when we look at home ownership versus renting, because there's a lot of great elements of home ownership that we reap the benefits of that we don't necessarily get in the rental side of things. Now, to kind of frame that up for you, I thought I would share with you guys the rent versus buying calculator. And I'm going to ask Ken, if Ken, are you able to screen share the rent versus buying calculator for the class? And what we'll do is we'll have, if Ken can bring that up, if not, I'll drop into this link. By the way, while we're waiting to screen share that calculator, I did want to share back with everyone that we are recording tonight's class. So we'll send a recorded version of tonight's class out to you via email tomorrow, along with our slideshow from tonight's class. And we'll also have the class up on our YouTube channel. So if you want to take a look at that, you can do so. So if you have to step away from your computer, not a big deal. We want to make sure that you have all of this important information. So take some great notes, because obviously that'll help with just retaining some of this material, but certainly want to be able to pass along some of the tools that we're sharing with you tonight. And Ken, if you're unable to share that, I can kind of walk our class through kind of what that calculator looks like. We're having some Zoom issues on this side here, so I want to make sure that we don't mess up the screen share. So, all right. Well, what I will share with our class here is this rent versus buying calculator is essentially one of the tools that we provide during your consultation to you. And what that is essentially looks at, in one column, what does it look like today if I continue to rent, and what would that be like for me? On the other side of it is going to be on the home ownership side. What's the difference in looking at home ownership versus renting? And the upside when we factor in tax benefits, equity appreciation in my home, and we create break-even points essentially for ourselves. So we want to make sure that we're breaking even in a certain amount of time. So the calculator can be found using this link. I'm going to let you guys explore that calculator on your own. I think it's a great tool for you to kind of look a little bit closer into home ownership and just kind of really better understand budgeting for home ownership. So we're going to kind of move along here and now talk a little bit about the housing market and kind of what's happening in today's housing market. Because when we look at today's market and what is occurring in today's market, we are currently in the spring buying season. And in the spring buying season, we generally see a lot more activity in the markets. We see sellers that are more apt to put their homes on the market. Obviously, the weather is a little bit nicer in most parts of the country as we move through April and into May. That also brings more buyers out into the market because they're thinking about, hey, I'm getting ready to move in the summertime. Maybe I want to have my family in a certain community or be part of a certain school district, whatever the case may be. So that's where we see a lot more activity in the housing market in spring and the summer buying season. So what we're seeing here on screen is just housing trends in the Virginia market in the last 3 years. And we're seeing a little upward spike in sales price activity. You can see this movement of prices here in the market, and certainly a good trend for sellers, not as good of a trend for buyers. What's driving prices a little bit right now? We just don't have as much inventory in the Virginia housing market as we need to supply buyer activity. So that's kind of one of the challenges that we're facing today in the market. So we're kind of that can be a little bit challenged. So we're a little bit of lack of supply here, even though you can see home solds are up 8.4% year over year. The challenge is we just don't have enough inventory to support. Now, new home builders are trying to offset some of that gap, if you will, but still need more supply in the market. So a lot of activity in the Virginia housing market. This is also a quicker turnaround time in the market. So 41 days median days on the market, believe it or not, is probably one of the shorter days that we're seeing on the market across the country, because we work in communities all across the country. And so homes are also selling faster. Now, what do we see as the forecast for 2026? Well, as we look into 2026, we're going to see a little bit of a reset in the home buying market. Things should be a little bit more affordable, may not feel like that right now. We're expecting interest rates to go lower. However, kind of with the conflict currently in the Middle East, that is casting a little bit of a cloud over our original projections as we enter 2026. So we'll see kind of where rates ultimately settle. I think hopefully once some resolution happens with the conflict in the Middle East, we'll see rates kind of start to continue their trend because, and we'll talk more about this in our rate segment. On February 27th, rates were just about to go below 6%. And of course, the conflict arose and, there we go with interest rates rising higher. So I think from the interest rate perspective, we still will eventually see rates start to decline. Price growth is expected to be modest this year. We won't see any huge jumps in prices. But many areas, may have small dips, but ultimately, hopefully some stabilization in most markets across the country. There's 4 states right now that have the highest level of supply right now, and you may be considering buying in those markets. That would be Florida, Georgia, Texas, and Colorado, all markets that we support with our organization. But those tend to be higher supply markets with the most, buyer leverage, I would say, in those markets. We look at inventory across the country. We will see inventory slightly improve in most markets, which could give you buyers a little bit more opportunity. Probably not as extensive as we see in those 4 states that I just mentioned, but certainly we're going to see some inventory start to rise. I think the challenge that we've had over the last 2-3+ years is that most existing homeowners really can't afford to sell their home, because if I currently have a home that I refinanced back during the pandemic at 2.5% or 3% rates, it's really hard for me to trade out that 2.5% or 3% mortgage and then jump up to a 6.5% mortgage and maybe a more expensive home. In general, it just doesn't make sense for them. So that has been kind of the backlog of supply. We just don't have sellers that are willing to trade up to the next house. I think that's starting to change. And in my own individual conversations with clients, we're starting to see sellers that are like, hey, I really need more square footage, so I'm just going to have to go for it and jump into the market, even though maybe interest rates aren't ideal for me. So, obviously we're watching supply really carefully for our clients, because ultimately that is what can fuel this housing market beyond what we see on the interest rate side. I do think, as I mentioned before, as we launch in tonight's class, for those that are financially prepared or financially fit, I think there are some opportunities really entering the market. Now, I know everyone wants the lowest priced home. They want the lowest interest rate option. I totally understand that. It's very tough to time the market from that perspective. But I think if you're in a financially good position, with where interest rates are at, with kind of what's happening in the economic climate, there are many buyers that have to be on the sidelines just because of where the economy's at. But I think if you're in a good financial position, there is a good opportunity to jump in today's market. Well, interest rates will also kind of time that for us as well too. And interest rates have a little bit of a roller coaster ride, especially over the last, we'll say, 2.5 months. As I just mentioned to you, February 27th, we saw interest rates starting to trend lower. Super excited about that. And then obviously the conflict arose, and you can see this is represented in our graph here, where interest rates have spiked here. Now they've come back down a little bit because it's, we'll see a ceasefire happen, and then the markets will like it. We'll see oil prices start to drop a little bit, and then, we'll get some improvements in the markets. But it's been a very volatile, choppy market. Interest rates actually spiked a little bit higher than this graph represents. We almost saw rates to go back to about 6.75%. So, I think as we continue to move through this year's markets, I do think we'll start to see rates get into that low 6 range. But, currently we stand right around the 6.3 to 6.4 range in interest rates. So this gives you a snapshot of the last 12 months of interest rates. I do think we'll see things go a little bit lower once we get beyond the conflict. But let's look a little bit further back, and let's talk about the last 30+ years of interest rates, because I think it's important to have some perspective. The housing market cycles, interest rate cycle, and many of our clients that I talk with look at interest rate markets specifically and say, hey, I'm going to wait for rates to get to that 2.5% or 3% level that we saw back in 2021. Probably not likely for that to happen, especially if that was to happen, then something really big has happened across the globe. And, the historical average on interest rates puts us in the high 4s to low 5s. So certainly we're above that in today's market. But nonetheless, I think when we look at where interest rates are going, we will trend lower It's not a question of if, it's more of a when. And certainly there are some factors in the economy that will drive those interest rates lower. Now, the Federal Reserve has a mandate to get inflation to 2%, and then looking at the health of the labor market. So that will determine how and when they're going to cut interest rates at the Fed level. Now, inflation is starting to trend lower. It's getting closer to 2%, not at that goal yet. I think where we haven't really seen the impact at this point is in the labor markets, payroll numbers, job creation, all that important stuff for our economy. If those numbers are softer in the labor markets and we see cooling inflation, that would give the signals for the Federal Reserve to potentially cut interest rates. And of course, we love to see a cut in interest rates. Now, when the Federal Reserve does talk about that, it's important to understand that when the Federal Reserve makes an announcement of a 0.25% cut in interest rate, that's not a 1-to-1 ratio cut to mortgage interest rates. And the reason why that is because a lot of what the Federal Reserve is speaking ahead of a rate cut gets baked into mortgage interest rates. So you'll generally see mortgage interest rates decline in anticipation of what the Federal Reserve is going to do. But when the Federal Reserve makes that decision to cut interest rates, that's when you'll see your credit card rates drop lower, your auto financing, your yields on savings accounts will drop. So that's kind of usually the timing of when the Federal Reserve or the impact in the markets when those decisions are made. Now, as it relates to mortgage, interest rates are not the same for every client. And so even if your neighbor achieved this interest rate or your classmate got this interest rate, doesn't mean that would be the same interest rate for you, because interest rates move by the minute according to what's happening in the economic markets. So the trading day starts at 6 a.m. Pacific time, moves to 2 p.m. Pacific time. All throughout that trading day, interest rates move all over the board. And so as a potential buyer, that's important to understand. In partnering with us, we're going to strategically look at the markets to see what we can do to time the best level of interest rate to lock at. And inside of an interest rate, there's different characteristics that make up that rate. Things like credit score and eligibility for a product, the loan program, how much I'm going to finance, what my down payment looks like. If I'm putting 3% down versus say 20% down, those are going to have some different looks to interest rate. And you may see this in some of your searches, is that you can buy points to bring down your interest rate. So usually 1 point is the equivalent of 1% of your loan amount, and that will generally drop your rate about 0.25%. Now, I don't recommend buying points in today's market because for most clients, the break-even point for that investment is about 4 years. And so highly likely that if I bought in today's market, I'm probably going to consider refinancing a couple of years when rates trend lower. So if I bought my home today at 6.5%, when rates hit to 5.5%, then I'm going to probably consider refinancing my home. Last thing that can make up an interest rate is the loan term. So generally, the shorter my term is in my loan, the better my interest rate is going to be. So traditionally, our first-time buyers are going to be looking at 30-year fixed mortgages, but maybe I'm in a really good budget position and I want to drop to a 15-year fixed loan. Well, the difference between a 30-year fixed loan and a 15-year fixed loan is anywhere between 0.25% to about 0.5% in interest rate. As I get a chance to meet with you for a consultation, we're going to design some options around the right product, the right interest rate, down payment. All those are really important elements that go into a home buying plan as we get a chance to meet with you for a consultation. And we'll kind of talk more about strategy around interest rates. We'll dive into more strategy around interest rate locks later on during our workflow segment when we talk a little bit more about the 6 steps of home buying. I want to switch up gears a little bit, talk to you a little bit about credit. And credit's one of those bigger drivers for our financing options when we consider home ownership. You just saw in our rate segment that credit score can drive the interest rate. Every product does have a minimum credit score, and you can see some of those programs highlighted on screen. When we think about the credit score minimums, that is the minimum entry point for a loan program. But as we go deeper into those programs, there's different tiers of loan interest rate pricing, as well as the cost of mortgage insurance. And we'll spend some time talking about mortgage insurance in just a bit. Now, there are 3 different models to credit scoring. There's the credit card model, there's auto financing, and then there's the mortgage model. Now, for those of you that monitor your credit, which I would encourage you to do so, usually tools like Credit Karma or maybe the Amex credit tool, they're going to use that credit card model to give you a credit score. Now, that's going to look a little bit different than the mortgage model. So there's different variables that go into the credit card model versus mortgage. So when you're getting ready to apply for your mortgage, you may see differences in credit score, but it's just because they're different models. And I'm going to walk us through the mortgage model here in just a few minutes. Now, when we look at the impact to my credit score, especially if I've had maybe some challenges, maybe I had a late payment a couple months ago or maybe last year. When I have an event that takes place on my credit score, especially in the most recent 12 to 24 months, that's going to have the biggest impact to my credit score. Now, as I move further away from that late last payment, so let's say I had a late on a student loan back in October of 25, still probably pretty impactful to my credit score. But as I move further away from that late last payment, I'm probably going to see my score start to organically lift. Now, we're going to spend some time talking about credit utilization a little bit, some tips and tricks around your credit score. But there are 3 different scores that get reported out. Obviously, you guys know the 3 agencies, Experian, Equifax, and TransUnion. We always take the middle credit score of those 3 agencies reporting out. So if your highest score is 760, your middle score, let's say with Equifax, is 740, and then your lowest score is 720, we're going to use the 740 score when it comes to evaluating your product options, of course, interest rate. If you decide to apply with a partner and your partner's middle score is, let's say, 720, well, that 720 will drive that interest rate, product option, and mortgage insurance. So we always look at the lowest credit score between both borrowers. Well, if you've had some past challenges on your credit and you're just trying to figure out how long are those things going to stay with me, how long is that going to make that impression on my credit report, this matrix will kind of help you better understand that. So this is how long a negative item will remain on your credit report. Now, the impact, again, how it's going to impact your credit score is in the most recent 12 to 24 months. So if we use my example of the student loan that was late in October of 25, like that's going to be on my credit report for 7 years. But the impact to the scores in the most recent 12 to 24 months from the date that creditor put that reporting onto my credit report. Now, bigger items such as charge-offs, bankruptcies, those are going to have bigger impacts to my credit score, but you can see the timeline of how long they'll stay with me on my credit file. So as I mentioned, there's the mortgage model, and the mortgage model, of course, is what we're going to use in determining your eligibility in housing. And so I want to take you through the mortgage model so you can better understand maybe some areas of opportunity for you in your own specific credit score. And so this is what that looks like. I'm going to kind of walk us through every area. And my goal is in teaching this part of our class is that maybe you can identify some areas of opportunity for you in your own credit profile. Now, as I get a chance to meet with you one-on-one to figure out your home buying plan, we'll identify areas as well for you. So looking at utilization of credit or maybe limited credit lines, we're going to talk through all that stuff. So speaking of credit lines, this is length of credit, which is 15% of the weighting in the credit score. We're looking there at how much seasoning do I have in my credit file. So if I've had credit open for 6 months versus 6 years, obviously the 6-year profile is going to have a higher credit score, assuming everything else being equal. Now, at the same time, we want to limit how much new credit we're trying to get access to, which is 20% of the weighting. So we want to be very cautious in opening up new accounts, especially in a 6 to 12 month time period. There's a balance between opening up too many accounts and just having just enough for the right credit score. But I would encourage you to probably not open more than 1 account in a 6 to 12 month period, just to limit the amount of credit activity, because every time you apply with a creditor, whether it's a car loan, credit card discount at the department store, or mortgage financing, they're generally going to run a hard inquiry, which can have a negative impact in your score. As we design options for you around home buying, we start in our process, especially because it's a very consultative process, we only start with a soft credit check. And the reason why we do that is because we want to help educate you up in home ownership without impacting your score. So when you decide to do a consultation with us, we will only do a soft credit check. Next area is amount I owe in revolving debt. And that's probably one of our biggest areas of opportunity for our clients. That's looking at credit card or revolving debt. So if I have revolving debt of, let's say, $5,000 and my credit limits are $10,000, right now I'm at 50% utilization. Well, let's say I just booked that trip to Cabo for summertime, right? And I'm super excited about it, but I put a little bit more on my credit cards, and now my balances have moved to $8,000. So now I'm at 80% utilization. Well, when I did that, I probably saw my credit score start to come down a little bit. So we look at managing credit card debt. What I always encourage our clients to do is take a look at your billing statement date and then your due date on those accounts. The due date, of course, is when the payment is due. The billing statement date is when the credit card issuer or creditor closes out all your activity for the preceding 30 days, and then based upon your credit activity, sends out all that data to the credit agencies. My tip for our class tonight is to try to pay down your credit card debt or pay it off ideally before that billing statement ends. Because if you can do that, you get ahead of the reporting out to the agencies and therefore lower your utilization, help improve your overall credit score. Now, ideally, that same scenario, if I'm at 80% utilization, ideally I want to get that down to 10%. I want to eventually whittle those balances down to about $1,000. But I would say a client that I'm working with that's at 80% utilization today, our first kind of building block goal is to get to 50% utilization, then 30%. So now it's $3,000 in balances, and then eventually get to $1,000 or less. All right, so that's utilization. Last component. This one's pretty self-explanatory, right? This is payment history. How have I paid my bills? The bigger a late payment has been in that 12 to 24 month period of time, bigger impact I'm going to have to my credit score. Late payments are rated as 30-day lates, 60-day lates, and then 90+ day delinquencies. So we want to obviously, if we have a late, hopefully it's not in the higher days overdue scenario, because then it's going to have a bigger impact to my score. And of course, that's 35% overall of the weighting. As we look a little bit more closer into accounts that appear on my credit report, student loans are a topic of conversation with clients. And I always like to go into this part of our class because there's a lot of misconceptions out there, especially around student loan debt, that's going to be prohibitive for you to be able to get access to home financing. It's really not the case. We just have to better understand the student loan debt and how it can impact your expenses versus your income ratio. Now, many of you that do have student loans, if you're getting, notices right now from your student loan servicer, there's probably you're gonna be requalifying for income-based repayment programs, or they're just letting you know that you're gonna have student loan payments starting to come due at some point. If you're actively paying on your student loans right now, that's totally fine. Whatever that payment looks like, I gave you an example we have on screen with someone that has $75,000 in debt. If you're paying that $250 payment per month right now, that's the payment we're going to use from a qualifying perspective. Where we run into a little bit of challenges, and I don't know if challenge is the right word or not, but it's when we have clients that are currently in forbearance or deferment. So deferment means you're probably back in school, and so they're not starting the repayment program. Forbearance is still, part of what we faced in the pandemic, where a lot of student loans are put on forbearance, and there's also litigation tying up student loans right now. So when you're in forbearance, if you're doing an FHA loan, then we do have to count 0.5% of the overall balances in your qualifying as a monthly payment. So that would be on an FHA loan with the same $75,000 in debt, about $375. If you're doing a conventional loan, which would be a Fannie Mae and Freddie Mac loan, it's 1% of the balances, or $750. And so what we do is we plug that into an expense calculation versus income. And we're going to talk about that later tonight. More specifically, it's called debt to income ratio. But student loans shouldn't be prohibitive for us to be able to purchase a home. We have to better understand them. And so as we work with you during your consultation, we're going to talk through student loans and what's active in repayment, what's not, and how that impacts your overall buying power. Now, the reason why we look at student loans is because every loan program has guidelines around student loans. So now I'm going to give you kind of a high-level look at different loan programs. A lot of this terminology you've probably already taken on yourself or discovered in some of your searches. But let's kind of talk through this a little bit so you can get a little bit more of a look into these products. The first one is a conventional loan, which falls under Fannie Mae and Freddie Mac. With a conventional loan, if I'm a first-time buyer, it's a minimum down payment of 3%. Up to the conforming loan limit, which today across the country is $832,750. That means I can borrow up to that loan amount and essentially be able to put it as low as 3% down. Now, if I'm looking to buy my house in Arlington, Virginia, well, Arlington's a high cost of living area. Many of you that live there probably know that. So what that means is Fannie Mae and Freddie Mac allows us to go to higher balance limits. You can go up to $1.2 million in that market, but the down payment minimum goes from 3% to 5% in that market. Now, if we look at the next product, that's the FHA home loan. FHA is a government insured loan, has a minimum down payment of 3.5%. It is a government insured loan, so we'll talk more about the mortgage insurance that's involved in a government insured loan like FHA. But FHA stands for Federal Housing Administration. The loan amount for FHA does vary by the county that you're going to buy at in the country. Now, both FHA and USDA, for that matter, since they are both government insured loans, there was some changes in eligibility as it relates to residency. So you have to be a permanent resident to access either one of these programs. As a conventional loan, there is no resident requirement. You can be a non-permanent resident and still participate in a conventional loan. It's just these two programs, unfortunately, had changes to who can participate in these programs. The USDA loan, just below the FHA product, is designed for clients that are going to purchase in more rural areas. And the benefit there is that it's 100% financing down to a 620 credit score. And then the maximum loan amount varies based upon where you're going to purchase. So there's basically two qualifiers around USDA. The location has to be deemed rural. Second thing is we're going to look at income as it relates to your household size. And then jumbo loan, which is right up here, that's not going to be for our typical first-time buyer scenarios, but it's certainly on the table for us. The reason why it's not, because it's really going to go to clients that want to purchase in, the million plus range. But it does also have higher down payment requirements, 10 to 15% down, higher credit score requirements. Certainly an option for us if we can't get our financing because in the conventional space, because we exceed that loan amount on that product line. And then finally, the VA home loan. That's for our veterans that have eligibility in that product. The veteran has the opportunity to put zero down to utilize the VA home loan, just a lot more flexibility in the qualifying for the veteran. And there's really no maximum loan amount on the VA product. Now, one product that we don't have listed here, but I always like to kind of spotlight it in our classes, is we do have a physician's loan. So if you're in residency or actively practicing right now, the physician's loan allows you to put a lower down payment like the 3% level. But the difference from, say, a conventional guideline here is that there's a little bit more of a relaxed policy around student loans. So if I, unfortunately have a lot of student loan debt right now, the qualifiers for that will be much more relaxed, which will, obviously allow you as a practicing physician to be able to get access to homeownership. All right. We're going to talk a little bit about PMI. And just as a quick side note, I know we're encouraging questions in tonight's class. So on my side, I'm having a little bit of Zoom issues in terms of being able to field the questions in the chat and the Q&A, but I don't want to get us off track for our timeline for tonight. So I know Ken's co-hosting with me, so I'm going to ask Ken if he can kind of just manage what's in the chat and Q&A because I'm unable to see kind of some of those questions coming in, so I don't want to miss anything from our audience. And then hopefully we'll get that figured out.
No questions yet, but I will jump in if I see any.
Awesome. Thanks, Ken. I appreciate it. All right. Well, we're going to talk a little bit about PMI. And PMI comes into play in most loan scenarios when I put less than 20% down to purchase a home on a conventional loan. And on an FHA loan, it's in place regardless of my down payment. So I want to kind of talk a little bit about both products. On the conventional side, the minimum down payment, as we heard, is 3%. But that is less than 20%. So when I put less than 20% down on a conventional loan, I am going to have mortgage insurance, which is called PMI or private mortgage insurance. So oftentimes clients will ask, well, Jason, what is PMI? Well, PMI basically insures the lender against a default by the buyer. So if something happened, there was an economic hardship, I was unable to pay my mortgage, the PMI company would step in and provide protection to the lender. That PMI that you pay as a buyer is based upon your down payment, your credit score, and then how much you finance. So the higher I can put my down payment, the more I can lift my credit score, probably the cheaper my PMI is going to be. Now, one of the benefits with conventional PMI is that once I reach 20 to 22% equity in my home and I have 2 years in that original loan, then I can apply to have my mortgage insurance canceled. And for those of you that have started your search on Redfin or Zillow, maybe you're just using some of the calculator tools that are available on those sites. What I've found in feedback from clients is the mortgage insurance tends to be a bit inflated on those sites. So for example, if you look at an actual scenario with these factors, someone financing, say, $450,000 with a 3% down payment, their PMI is only probably going to be about $138 a month. And if I can lift my credit score to 760 or 780, then that would also bring down that cost of mortgage insurance. Just so you have a little bit more kind of behind the scenes look at things, when we look at things like credit or mortgage insurance costs, to try to lower that cost of mortgage insurance, there's a pricing scale of mortgage insurance. And it goes like this. So let's say we'll start at the 700 level, but 700 would be the entry level there, 720, 740, I get to 760. If I go to 780 plus in my credit score, then I'm going to see the optimal levels of cost of mortgage insurance. Then if I can elevate the cost of or the down payment that I'm putting in, that's also going to drive down my overall mortgage insurance cost. So, hopefully the takeaway here is when we think about conventional mortgage insurance, it's not a one size fits all. On the FHA side, certainly looks a lot different. It is government insured and it's called MIP or mortgage insurance premium. Now there's two components to it. There's monthly mortgage insurance and then there's upfront mortgage insurance. So the monthly is calculated at 0.55% of my total loan amount. And then we figure out a monthly figure dividing by 12. And then we add the upfront mortgage insurance into the loan amount. And then with FHA, there is no cancellation option. So really, we're going to look at FHA as kind of the launch pad into homeownership if our clients don't qualify for conventional. So why would we go to FHA versus conventional? Well, we could have some credit score challenges, maybe some past late payments, like the example I gave us earlier. FHA is a great entry point to homeownership for buyers that just need a little bit more flexibility in the overall guidelines. Now, thinking about that as being kind of an entry point to homeownership, once our clients maybe see some improvement in credit score, equity position in their house, then we would want to look to refinance out of the FHA loan into more of a conventional loan because there is no cancellation on mortgage insurance with an FHA product. And here's the calculation of MIP down below. You can see the 450 loan amount. That's the upfront mortgage insurance that we would add on. And you can see clearly there's a difference in monthly amount. So as I get a chance to meet with you for your session, for your consultation, we're going to figure out the right design for you with the right product to meet your homeownership goals. And obviously, ultimately is create affordability for you in homeownership. Well, let's talk a little bit about income. I'm going to kind of pivot a little bit because we're going to talk now about income and then go into assets. From an income perspective, I get a lot of questions around, does my income qualify? Have I been on the job long enough? Does this work? Can I count my overtime? That kind of stuff. So I first wanted to provide you guys with the documentation that we generally ask for from our clients as we work with them to build their home buying plan. So you can see this listed here. It's also up on our website. I'll share more with that later in tonight's class. But so that's kind of the general documentation. Now let's talk about some of those income scenarios I just shared back with you. In financing, we do have to verify a 2-year work and or educational history. So what does that mean? Well, let's say I graduated from UVA last fall. I just started my job first of this year. I've only been on the job for 4 months, but I want to buy a house. Well, you can put together your educational history along with what you're making on your current job and how long you've been there to make up that 2-year history. So I don't necessarily have to be on the job 2 years in order to qualify for home financing. I just have to put together a 2-year track record of education and or work history. So that's kind of how we look at employment. Now, it does vary in certain scenarios. So let's say, for example, I'm working for a company that has a bonus structure. So I get a base salary of $60,000 plus I have a bonus it gets paid on quarterly. If I want to count the bonuses I get on a quarterly basis, we have to show that I've been on the job for 2 years in order to get a historical perspective on that bonus, because generally we're going to average the last 2 years of bonus income. Same thing would hold true with like commissions, or maybe I'm in an hourly role that I make overtime. The underwriting guidelines require us to do an assessment over 2 years to determine, the stability and the trajectory of those sources of income. If I am self-employed, in that case, we have to show 2 years of tax filings. To do kind of a similar analysis, we have to do a look back at the net income for that business and do an average of 2 years. If I have dual employment, let's say I'm in the healthcare field and I'm a dental hygienist and I work for 2 different dental practices, working one at 30 hours a week, 20 hours at the other, but I want to count both sources to verify my income. In that case, we do have to show that that person's been working at both practices simultaneously for the last 2 years. It also would hold true too if I had a 40-hour work week job, but let's say I have a little extra time and I do DoorDash on the weekend, right? Well, DoorDash pays out as a 1099, which is essentially self-employed. In order to count that source of income, we have to show that we've been on both jobs simultaneously for the last 2 years. Okay, so those are a few scenarios that come across our desk as we're working with clients. Last thing I wanted to share with you in tonight's session as it relates to income before we talk about comparing those to expenses is some scenarios we'll have that we have a partner that's contributing to the household income, but they're not planning on being a part of the transaction. So not going to be a part of the application. So in most loan scenarios, we can't count the income that that partner is contributing unless they plan to participate in the application. Now, we look at the income, we assess, we do our calculations in lending, but then we compare that to expenses that you have. Current expenses today, like let's say personal loans, credit cards, student loans, right, that we talked about earlier. And then we also factor in your projected housing expense, things like the principal and interest of my mortgage, my taxes, my insurance, PMI if I put the less than 20% down. Maybe I'm buying a condo or a townhouse, then I want to think about homeowners association fees that will become a part of my calculation. So what we do as a lender is we take those current expenses, the projected housing expense, and we gave you an example here on screen. So with someone that has $2,500 in their new mortgage or housing expense plus $500 in existing debt, and they're making $8,500 a month, that tells us that those expenses today and projected expenses on the house are basically going to consume 35.3% of their pre-tax income. We call that a debt to income ratio calculation. We are looking at the pre-tax income, so it's a different look at things. It's not obviously your net income, but it gives us kind of a gauge of where your expenses look like versus your income. And the guidelines state that we can't be higher than 50% of our gross income to expenses. Now, that's a pretty big number. As I work with clients all across the country, I'm being asked, like, what's really the sweet spot, Jason, I should be at to be able to hit the right number in debt to income ratio? My recommendation, and what I've seen is kind of the success metric for most clients, is when that's around 33 to 36%, that's generally kind of the sweet spot. And I think in most cases, it's kind of really the affordability range. And affordability is super important for us. So as we're working with you to kind of design your home buying plan, we want to make sure we hit the mark when it comes to affordability, making sure that payment is sustainable for you. So if there are economic challenges in the future, this can be a manageable payment for you. All right, last topic before we go through workflow of buying a house is savings for homeownership and really down payment. So you've heard a little bit about the minimum down payment requirements. So I want to share with you some of the asset accounts that we can use to fulfill that down payment. And then we want to talk a little bit about what it looks like in terms of first-time homebuyer resources. So when we think about savings for homeownership, we're saving up for down payment, which, as we learned earlier, is about 3% of our sales price if we elect to go with the minimum down. Plus, we also have to save up for what we call closing costs and prepaid items to purchase a home. Closing costs are going to be third-party costs. They're going to be title, attorney fees, local county fees. We also have prorated taxes, insurance, lender fees. All that stuff gets encompassed. And there, usually we recommend clients to budget 2 to 3% of their sales price for those closing costs and prepaid items. You could pull those assets from a various amount of accounts. Now, you can use checking and savings accounts. Those are certainly allowed. We just can't use cash unless it's seasoned for 60 days in those accounts. So every asset involved in home purchase has to be seasoned for at least 60 days. Any large deposits we have to document. Maybe you just got your tax refund from the IRS. That can be certainly used towards your home purchase, but we'd have to obviously source where it came from. You can certainly use retirement accounts, investment accounts. We always encourage clients, before you dip into some of your investment vehicles, talk to your financial or tax advisor before you access those assets. We just want to make sure that you're doing the right thing financially and, of course, not creating like a tax liability for yourself. And then gift funds can also be used in a home purchase. Now, they don't require seasoning, but we have to just basically track where the assets come from. If you have your grandmother wants to contribute $10,000 towards your home purchase, that can certainly be allowed. Your grandmother would just have to complete a gift letter, and there's some documentation to that. We would obviously help you through that. So those are kind of how we look at assets. Now, as we launched in tonight's class, I mentioned to you, savings is probably one of the bigger challenges for homeownership. Maybe I'm just doing great in my job. I'm making good cash flow. I have a manageable rent situation, but I just can't hit the mark in terms of savings for homeownership. And, hopefully after leaving tonight's class, you've realized that, hey, I don't have to save up 20%. I can put as little as 3%. But for our first-time buyers, saving up for homeownership can be a challenge. So I always like to, in this part of our class, is just to kind of give you a really simple savings plan. And it looks like this. So let's say, for example, that I'm currently paying $1,500 a month in rent. And like I said, we're doing well with that. But I really want to get to homeownership as one of my big goals for the next year or two. And I think I can afford about $3,000 a month, given what my cash flow looks like. What I would encourage that client to do as we're meeting for their consultation is let's start saving like we're making that $3,000 mortgage payment today. So on the first of the month, I send over my $1,500 to my landlord, but I do a one step further. I take an additional $1,500 and transfer it straight to my savings account. So I kind of simulate like I'm making that $3,000 mortgage payment. And then over the course of the next several months, I start seeing those funds start to stack up for myself. So after 6 months, now I have $9,000 built up in my savings account. End of a year, I'm at $18,000, not to mention if I can get a high yield savings account to put that money into. And so it's obviously building the savings account, which is great, but it's also creating that rhythm and that discipline of making the mortgage payment. So when I decide to step into home ownership and now I go from $1,500 in rent to $3,000 in mortgage, it doesn't feel like a big payment shock for me, right? So that's just a simple approach. It's obviously a very simple mathematical approach to home ownership and savings, but really encourage you guys to take a look at that. We've had several clients that have taken that on themselves and really built a really strong nest egg for home ownership. Now, first-time home buyer programs can also close the gap for you as well, too. So in the state of Virginia, we have the Virginia Housing Conventional Program, which offers lower borrowing costs for first-time home buyers. You can also participate in the down payment assistance grant, which is 2 to 2.5% in assistance. As a side note, there are income limits to these programs. So during a consultation, we're going to see if these kind of fit for you or not based upon the income criteria. The Housing Plus Second program, which provides anywhere between 3 to 5% in assistance for down payment and closing costs. There's a lot of great resources to close the gap for you. Within APM, we have the 1% program, which essentially is designed for borrowers that make less than 80% of the median income. So if you contribute 1% of your own funds, APM will contribute up to 2% in assistance funds to meet that 3% minimum down payment requirement. So that's a great tool for you that we can tap into. And then the Pathway program, which by the way doesn't have an income limit, where you can get anywhere between 3.5% to 5% of your sales price in assistance funds. So hopefully you find some encouragement in some of these resources that are out there for you. You may not be looking at the Virginia market. Maybe you're looking in the state of Georgia or Texas or California. There are similar programs available state by state. Most states have what we call an HFA, which is a housing finance agency. It's designed to support low to moderate income households in home ownership. And so if you're looking at a specific state, we are an expert in first-time homebuyer programs. So if you'd like to connect with me either in tonight's class or, of course, after class, we can kind of go through some specific scenarios for you. All right, we're going to come to the latter part of tonight's class and take you through, which I think is probably one of the most important components of homeownership, is really understanding where do I go from here? What's the buying process look like? I've attended tonight's class. I got a few takeaways. Where do I go from here? Well, I would encourage you to get connected with us for our free consultation, which allows us to meet with you and kind of figure out what a plan for home ownership looks like. That's a 30-minute virtual session that I do with every client one-on-one, and just dedicate the time into helping you better understand home ownership and set some goals for you. And our approach is a little bit different than most lenders because we're not expecting you to run out and buy a house at an open house this weekend. It's to provide a roadmap to home ownership. So whether you want to buy next month, next year, or 2 years from now, at least we put the framework together for you for a home ownership, set some action items, and then obviously goals around that to help you reach your goals of home ownership. Now, if you're ready to actively start looking, and maybe you're not even ready to actively start looking, the output of the consultation is to be pre-approved. Now, the pre-approval is good for 60 days, but we can always recertify at any time. So again, no pressure to go out and start actively shopping for homes. But let's fast forward a little bit. Let's say I am ready to go. Well, that would move us to step 2 in the process, which is house hunting. That's kind of the fun part. It generally starts online, and then you would eventually go into kind of more in-person, start touring homes. We would encourage you to connect with a local realtor that can help you with that process. They should be experts in the market, really be experts in negotiations, understand all your needs and wants for a community. We have a fantastic network of preferred realtors all across the country. So when we get to that stage in the process, after your pre-approval, we'd love to be able to introduce you to a preferred realtor. Well, let's continue to go down this path. Let's say I identify the home and I find the one I like, and I really want to make an offer on that house. Well, the realtor will help organize and construct that offer for you and essentially present the offer to the selling agent of that home. Now, you may fall in love with a home and that offer gets presented and maybe it doesn't get accepted. Maybe it does. But it's part of the process. But let's look on the bright side. Let's say that offer gets accepted, right? Now we're going to move to step three. Now we have a ratified contract between you, the buyer, and with the seller. Now, as your lender of choice, we'll get notified when that happens, and we'll give you a call and say, "Hey, congratulations, you did it. Your offer's been accepted. Now let's take you through some next steps and some action items, which will include getting connected with me for your follow-up video session, because we'll do a pre-approval session at step one, but now at step three, things kind of get a little bit more real, and we're going to walk you through all the important elements of your financing, which includes meeting with us for about 30 to 45 minutes, going through interest rates, what's happening with them, figuring out the exact monthly payment based upon that home, and then kind of going through all the details of your closing costs and prepaid items. Now, you're also going to have some action items from the title company and the escrow company, which will include making an earnest money deposit. And what that is, it's basically a good faith deposit in the transaction. Usually it's 1 to 2% of your sales price, and it counts towards your total out of pocket. And in most parts of the country, inside of the real estate contract, there's what we call as contingencies, which essentially protect that deposit so you as a buyer can do some of your investigative work on the home. Let's get inspections done. Let's see how the sewer looks. Let's see what the electrical looks like in the house. Let's check out the roof. All those things are really important to make sure this is a great investment for you. Your realtor will help organize those items. Now, on the lending side, we'll get the house appraised to make sure the value is supporting the purchase price. We'll get your loan approved to make sure your financing is all in place. Those items in the contingency period will generally happen in the first 17 to 21 days of this contract period. So if we look at step three here, and then the finish line here at step six, that's about 30 days, right? Now, the contingency period will generally run between step three to step five. So that's when we're getting all our inspections done, getting our appraisal done, getting our loan approval completed. All right. So as we move further down our workflow here, step four brings us to more of the administrative items in the process. We'll be verifying your assets, verifying your income. We're obviously, we've met by that time to kind of go through your follow-up video session. And as I mentioned earlier, rates change by the minute. So once you're under contract at step three with the seller, now we're having strategic conversations around the timeline of locking in interest rates and making sure that we're trying to get ahead of any economic news that could deteriorate rates, and try to lock you into the lowest rate available. So step four is the administrative side. Step five is going to be getting us further through the contingency period. Now we're at step five where we have a loan approval. We probably have the appraisal back by that time. You've probably already reviewed your inspections with your realtor, and you're probably hopefully feeling pretty good about the property because you've done all your investigative work. Well, at step five, now we're kind of tying that all together and getting us ready to go to the final stages. At step five, you're going to be signing off on your contingencies, assuming that everything feels good with the house. And as your lender, we're going to be delivering a final closing disclosure to you to start your 3-day cooling off period. Now, at each of those milestones that I just highlighted for you, you're going to be getting electronic disclosure sent to you, highlighting all the items that we've discussed in previous conversations. Now we move to the very final stage. That's the big day. That's the closing of the loan. And at that day, that's when you need to be in person in the lending process. You're going to be meeting with an escrow team member or a public notary to sign your final loan documents in person. If you're in Virginia, for example, purchasing, it's what we call a table funding state. So what that means is you will sign your loan documents the same day that you wire in funds, and that as your lender of choice, we're going to be also wiring in funds that day. And then items get recorded with the local county recorder's office. They'll record a transfer of ownership called a grant deed, then a deed for your mortgage that you're taking out. Once we get confirmation back that those items have been recorded, well, guess what? Then we're done. We're at the finish line. We did it. We're now homeowners, and it's a huge celebration. You know, it's the virtual high five. You did it. It's a huge, huge accomplishment. I get a chance to call clients. In fact, on my way to today's session, I got a chance to call a couple of our clients across the country that are getting the keys to their house today. Probably the best part of my day next to teaching a class like this. Our relationship, though, with our clients don't end there once you get your keys to your house, because it is a lifelong relationship with our clients. We've talked to our clients over the last several years. Part of our aftercare program keeps you connected with us, always watching what's happening in the rate market too. So if there's an opportunity to refinance your home, we want to be here for you. We provide a free tool called HomeBot system to track your home equity, and then always checking in with our clients to just see what's happening financial and see how we can be of service to you. So that's kind of what the workflow looks like. Now, if you're thinking about taking those next steps in homeownership, I'd love to be able to partner with you on that journey. The free consultation is something we do with clients all across the country and in your local market. Well, that starts with just really simple steps, which is just completing an online application. We do have to do that soft credit check that I mentioned. You would upload some documents and then use our scheduling system to schedule a call that works on your calendar. We meet together for a one-on-one for 30 minutes virtually at your convenience, just to kind of put all that framework and action items in place for homeownership and help you get on that path towards homeownership. Love to be able to connect with you for that session. And then if you have some questions after tonight's class, feel free to just book an introductory call. So if you want to just learn at a high level kind of what we do next, or just maybe a scenario on your income that you want to run by me, feel free to schedule an introductory call. Here's what that consultation looks like. It's very similar to what we've had in our discussion this evening, looking at the rent versus buying calculator, budgeting, looking at affordability, where do I want to buy, do maybe some of the first-time buyer programs map up good to what I want to do with homeownership, and then kind of doing another review of the buying process. I did want to point out some of our technology too. We really try to lean into technology, whether that's mobile, using some of our AI efficiency in our process. But my side note to that is it does not replace the human touch in our business. This is a big, huge financial decision that you're making to take on homeownership. So we really want to stay connected with you in the process, whether that's calling me, to go over a scenario, texting, email, whatever you need to make sure that you feel comfortable in the support you're getting throughout the process. Last thing I want to point out before we wrap up tonight's class is to share with you our discount that we provide to the UVA alum community. So in working with us, whether that's purchasing a home or deciding to refinance at some point in time, we pass along a discount in our closing costs of $750. Of course, you always have access to our first-time home buyer classes. In fact, many of our alum that have attended classes in the past are doing refreshers. In fact, I think we have a couple join us tonight that are just doing a refresh of some of our content over the last couple of years, but it's always great to have everyone participating in these classes. If you've enjoyed tonight's session, I would encourage you to share that with your friends, family, coworkers. But we also have other networked alumni partnerships across the country. So they are all open access to anybody in the public. So if you just want to have somebody kind of tune in one of those classes or just check out the YouTube recorded version, we'd love to have them check out what we're doing here. Here's all my information. So if you want to connect with me outside of tonight's class, feel free to reach out to me. And of course, you can book an appointment here. Do want to pass along our socials. So feel free to see what we're doing on our social platforms. We try to really give some great encouragement around homeownership, share some experiences from your own alum that have actually purchased with us, and just kind of share back with you what people say in our community, whether it's in our Reddit community or just in some of our reviews on Google. All right, well, that takes us to the end of tonight's class. Since I'm having some Zoom issues, Ken, if there's any questions in the chat or Q&A, if you want to just give me the audible version of it, I'm more than happy to share those back, or if you want to share it with the class and I can answer them kind of in a Q&A fashion that way. I don't know if there's anything in there.
I have not seen any so far.
Okay. Okay, so we'll hang tight for any questions that come in, and then we're certainly, and I apologize that we didn't get a chance to go through the rent versus buying calculator tonight, but certainly more than happy to do that with you on a one-on-one basis, and we'll make sure that you get a chance to get a good understanding of that. And then for those of you that missed it, again, we're going to share back all the slides from this evening. We'll send out the recorded version for you as part of the deck page that comes to you tomorrow. And then we'll have that posted up on our YouTube channel as well for you to look back to.
So we do have a question.
Yeah.
What if you get a new job within the past 24 months with substantially different income? How does that affect the DTI?
Okay, good question. So if we have a job change, in fact, I asked a very similar question to this earlier today in a consultation. If you going from base salary to base salary, no big deal. We can count that new increase in base salary income right away. So hypothetically, I'm making 80,000 today. I jump up to a job making $100,000. As long as that's a base salary position or guaranteed hours, then I can use that income right away. If there's a commission component to it or bonus component, we wouldn't be able to use that variable compensation because we have to see that historical on it. So we have to have at least 2 years on the job for that. But the jump in base salary is not an issue. One other thing I just want to, do you have another question? Okay.
Nope.
Okay. Um, the other thing I just wanted to point out too, sometimes, in qualifying clients with variable income sources, we see restricted shares. We see this a lot in the tech industry. So let's say I was working for Google and I have restricted shares of stock. Those can be actually counted towards income, RSUs. Um, but we do have to show, it's very similar with variable income. We have to show that you've been on the job for 2 years to count that source of income. One thing I'll just throw out to the group, because we get this question at times, which is, kind of the house hack, if you will, about purchasing multiple unit properties. We don't really cover it in our class, but I kind of just will go off script a little bit and sometimes talk about this. If you're looking to purchase, say, a two-unit property, if you're going to go down the conventional path, the minimum down payment is 5% on a multi-unit property. So anything from a 2 to 4 unit property is 5%. If you're doing an FHA loan, it's still a minimum down payment of 3.5%. The reason why I say it's a house hack, if you kind of look at it, some people look at it as a way to augment their outgoing expense for the housing. So if I'm, paying a total mortgage payment of $4,000 hypothetically, and I'm renting out one of my units for $1,500, that helps decrease my overall outgo. Most first-time buyer programs will not be compatible with multi-unit properties. But some of our clients are looking to purchase in, say, higher cost of living markets. It's a great way to kind of create a little bit more affordable homeownership. And in qualifying for those level of homes, they're generally a lot higher in expense. You can sometimes use that projected rental income to help with your qualifying on the debt to income ratio. Anything else in there, Ken, any questions that we should check out?
Nope, that was it.
Okay. Awesome. Well, I appreciate everyone attending tonight's class. Thank you so much for being a part of this. Look forward to getting all this information back out to you. And hopefully I get a chance to connect with you soon on one of your free consultations. Have a great evening. Look forward to seeing you soon. Good night. Okay, if you want to close out the session, I don't know if you can do it on your side.
I don't think it's letting me, but I can leave, and then when you shut down Zoom, it'll stop.
Yeah, I'm gonna try to exit out.